The 8 OPEC Plus countries said Sunday they will increase production by 547,000 barrels a day in a move which analysts say aims to regain market share amid resilient crude prices. According to a statement, the 8 participating countries will implement a production adjustment of 547,000 barrels per day in September 2025 from August 2025 required production level. The oil output hike was agreed by Saudi Arabia, Russia, Iraq, United Arab Emirates, Kuwait, Kazakhstan, Algeria, and Oman. OPEC Plus, which pumps about half of the world's oil, had been curtailing production for several years to support the market. However, the group sped up output hikes in recent months, citing low global stocks and rising demand. OPEC Plus began output increases in April with a modest hike of 138,000 barrels per day, followed by larger hikes of 411,000 barrels per day in May, June, and July. Expectedly, the output hikes can contribute to significant declines in oil prices. For instance, Brent crude fell over 6% to below $70 per barrel in April 2025. The increased supply, combined with rising production from non-OPEC countries like the US, Canada, Brazil, and Guyana, has raised fears of a global oil surplus. Global oil inventories have reportedly been rising by about 1 million barrels per day in first half of 2025, particularly due to weaker demand in markets like China. This oversupply has further depressed prices despite strong summer demand in some regions. The output hikes reflect a pivot from price stabilization to regaining market share, led by key members like Saudi Arabia and Russia. This move is partly a response to rising production from non-OPEC producers and aims to maintain OPEC Plus's influence in a competitive market. The output hikes align with US President Donald Trump's calls for lower oil prices to offset inflationary pressures from its tariff policies, including 25% tariffs on countries importing Venezuelan oil and threats of 25 to 50% tariffs on Russian and Iranian oil buyers. Lower oil prices benefit major importers in Europe and Asia by reducing energy costs, moderating inflation, and supporting consumer spending. This provides economic relief in regions facing high energy costs and trade war concerns. Fuzail Ahmed reports for DD India.